Bill Ackman, a titan of the hedge fund industry, has made a startling prediction of a potential financial collapse. This isn't just about numbers on a screen or fluctuations in the stock market. This is about a possible seismic shift that could affect an entire generation. Keep watching until the end to see why Bill Ackman thinks this collapse could change a generation. Trust me, you don't want to miss this. Ackman, an investment giant, has taken a stand against the prevailing optimism of a Goldilocks economy, where growth continues smoothly while inflation quietly subsides. He sees a less benign picture, one of persistent inflation that could disrupt this comfortable scenario. At the heart of this counter-argument is the strength of the economic activity and the resilience of the job market. Despite the pandemic's effects, the economic activity remains relatively robust, and the job market has proven itself to be more resilient than anticipated. While on the surface these sound like positive signs, they present a challenge for central banks. A robust job market fuels wage growth, and stronger wages could lead to increased spending, which then puts upward pressure on prices, thus driving inflation. In Ackman's view, this may result in central banks struggling to rein in inflation to meet their target ranges without causing unemployment to spike. What emerges is a picture of an economy treading a thin line, a delicate balancing act that, if upset, could lead to a turbulent future. This inflationary pressure, arising from robust economic activities and wage growth, isn't just an abstract economic concept. It's a very real fear for bond investors. Already, these anxieties have prompted a sell-off of longer-term U.S. bonds, leading to a rise in yields. With bond yields and bond prices having an inverse relationship, this rise in yields is a clear indication of falling prices. Ackman, in his economic foresight, sees a world with persistent inflation around 3%. This projection suggests that we're likely to see years of above-target inflation, translating into a prolonged period of higher interest rates. A shift like this has significant implications for both borrowers and investors. Ackman's economic forecast is not unfounded and is built on certain trigger points that could set the stage for the anticipated economic upheaval. One such trigger point could be the release of the U.S. Consumer Price Index for July. Economists anticipate an increase of about 0.2% for the month, a number that on its surface might seem minute. But viewed from the lens of year-on-year change, a reversal in the recent improvement could be signaled, with the Consumer Price Index expected to show an increase of 3.3% in the year through July. The other major concern revolves around the strength of the U.S. job market. A flourishing job market usually means higher wages, which in turn can fuel inflationary pressures. With U.S. jobless rate falling to near half-century low and hourly wages showing an upward trend, the fear of inflation looms large. Add to these the continuous U.S. government budget deficits and a potentially shrinking pool of bond investors, and you begin to see why Ackman and others are sounding the alarm about higher interest rates and the implications they carry for our economic future. Our exploration now takes us to the job market and wage growth, two key factors driving the inflationary fears. The U.S. job market's strength is apparent in the falling jobless rate, which has reached a low not seen in half a century. With this level of employment, wage growth inevitably follows. Data reveals that average hourly wages have increased 4.4% in July compared to the previous year. In the last 3 months, this has escalated to a 4.9% annual rate. High employment and rising wages may seem like positive economic indicators. However, they have a flip side when viewed through the lens of inflation. With more people employed and earning higher wages, the increased spending power can lead to an uptick in demand for goods and services. When this heightened demand outpaces supply, prices start to climb. This is the fuel for the inflation that Ackman warns about. These elements are interconnected, and changes in one can ripple through the others, affecting the economy as a whole. It becomes crucial to delve deeper into the dynamic state of the job market and the accelerated wage growth, both of which are significant actors in this unfolding narrative. They represent an interesting duality. On the surface, they symbolize a thriving economy. However, when examined under the lens of potential inflation, these signs of prosperity transform into possible red flags. To put the current state of affairs into perspective, recent data has unveiled that the U.S. jobless rate fell to a striking low of 3.5% in July. Such a figure hasn't been observed in nearly half a century, which unmistakably marks the strength and vitality of the job market. This decline in unemployment not only highlights the resilience of the economy in the face of adversities, but also paints a positive picture of the labor market's health. An expanding labor force and a decrease in joblessness represent a stage of economic advancement and progress. However, this vibrant job market also plays out in an arena of fierce competition among companies. Businesses are now engaged in an intense race, a sort of industrial battleground, vying to attract and retain the best talent. This competition among employers naturally incites a rise in wages, a tool to lure and secure talent. According to recent statistics, average hourly wages witnessed a 4.4% rise in July when compared to the previous year. But the story doesn't end there. If we zoom into the last 3 months, the acceleration is even more pronounced, with the annual rate shooting up to 4.9%. It's like an economic echo bouncing back with greater intensity each time. On the surface, these figures may seem like markers of a thriving, booming economy. However, they simultaneously stoke fears of inflation when evaluated in the current economic context. An increased employment rate paired with higher wages translates to more money in people's pockets. This is essentially equivalent to equipping consumers with greater purchasing power. But what happens when this heightened demand for goods and services outpaces the capacity to supply them? It inevitably leads to a surge in prices, a fundamental trigger for inflation. This is the very inflationary pressure that Bill Ackman and many other financial analysts have been sounding the alarm about. It's like a hidden beast lurking beneath the thriving economy, ready to unleash its power at the slightest provocation. Comprehending this economic paradox requires an appreciation of how these interconnected elements can have ripple effects on the broader economy, instigating a chain of consequences that may lead to a scenario as dire as the one Ackman forewarns. Ackman's prediction of a looming economic collapse is not just a vague conjecture, but a well-analyzed viewpoint based on these indicators and trends. His perspective, while it might seem unsettling to some, serves as an essential reminder of the volatility and uncertainty inherent in financial markets. It's like a wake-up call amidst a dream of an ever-booming economy. This understanding is a necessity as it not only helps us make informed decisions, but also prepares us for a range of possible economic scenarios. Forecasting economic events is not an exact science. It's more like trying to read